Business taxes are taxes imposed on businesses by governments at various levels: local, state, and federal. Here are some common types of business taxes. Corporate income tax. This tax is levied on the profits earned by corporations or large businesses. Self-employment tax. Self-employed individuals, such as freelancers, consultants, or sole proprietors, are generally required to pay self-employment taxes. Employment taxes. Businesses that have employees are responsible for various employment taxes, including a. Payroll taxes. These taxes include the employer's share of Social Security and Medicare taxes, as well as federal and state unemployment taxes. b. Federal and state income tax withholding. Employers are typically responsible for withholding federal and state income taxes from their employees' wages and remitting them to the appropriate tax authorities. Sales tax. Sales tax is imposed on the sale of goods and services by businesses. Property tax. Property tax is assessed on the value of real estate and personal property owned by businesses. Excise tax. Excise taxes are levied on specific goods or services, such as gasoline, alcohol, tobacco, and certain luxury items. Franchise tax. Some jurisdictions impose a franchise tax on businesses for the privilege of operating in that jurisdiction. Value-added tax, VAT, or goods and services tax, GST. These are consumption-based taxes levied on the sale of goods and services. Capital gains tax. When a business or individual sells an asset, such as stocks, real estate, or business property, any profit made from the sale may be subject to capital gains tax. Dividend tax. When a company distributes dividends to its shareholders, the recipients may be subject to dividend taxes. Import and export taxes. Businesses involved in international trade may be subject to customs duties, tariffs, or other import and export taxes on goods crossing international borders. Local taxes. In addition to national and state, provincial taxes, businesses may be subject to various local taxes, such as local business taxes, municipal taxes, or city-specific levies. Excise taxes on specific industries. Certain industries, such as alcohol, tobacco, gambling, or fuel, may be subject to specific excise taxes due to their nature or potential social impact. Business property tax. Businesses may be subject to property taxes on real estate or tangible personal property used in their operations. State franchise tax. Some states in the United States impose a franchise tax, which is a tax on the privilege of doing business within the state. It is often based on a company's net worth or capital, similar to the concept of state-level corporate income tax. Alternative minimum tax, AMT. Some jurisdictions, such as the United States, impose the AMT on businesses and individuals with high levels of income or certain deductions. The AMT is designed to ensure that taxpayers pay a minimum amount of tax, regardless of deductions or credits they may qualify for under regular tax rules. Payroll taxes. In addition to the employer's portion of Social Security and Medicare taxes, businesses may be required to pay other payroll-related taxes, such as state disability insurance or workers' compensation taxes. Net investment income tax, NIIT. In certain countries, there may be an additional tax imposed on investment income, such as interest, dividends, capital gains, or rental income, for individuals and businesses that exceed a certain income threshold. Environmental taxes. Some governments impose taxes or levies on businesses that produce pollutants or engage in activities that harm the environment. Securities transaction tax. In some jurisdictions, a tax is levied on the purchase or sale of securities, such as stocks or bonds. Business Improvement District, BID, assessments. In certain areas, businesses located within a designated business improvement district may be required to pay assessments or fees to fund improvements and services, such as security, marketing, or infrastructure enhancements, within the district. Digital services taxes. Some countries have introduced digital services taxes to capture revenue generated by multinational technology companies. Managing these taxes effectively is essential for businesses to minimize the impact on their finances. Here are some steps and tips to help manage business taxes. Understand tax laws and regulations. Stay informed about tax laws, regulations, and changes in your jurisdiction. Regularly review updates from tax authorities and consult with tax professionals or accountants to ensure compliance and take advantage of any available tax incentives or deductions. Maintain accurate records. Keep detailed and organized records of all business transactions, expenses, and income. Utilize accounting software or hire a professional bookkeeper to streamline record-keeping processes. Plan for taxes in your budget. Incorporate tax obligations into your financial planning and budgeting process. Estimate your tax liabilities and set aside funds accordingly to ensure you have the necessary resources to meet your tax obligations when they arise. Avoid using tax funds for other business expenses to prevent cash flow issues. Consult with tax professionals. Work with tax professionals or accountants who specialize in business taxes. They can provide guidance, ensure compliance, and help identify tax planning strategies that can optimize your tax position. Their expertise can help you navigate complex tax laws and minimize your tax burden. Optimize your business structure. The legal structure of your business can impact your tax obligations. Consider working with a tax advisor to determine the most tax-efficient structure for your business, whether it's a sole proprietorship, partnership, limited liability company, LLC, or corporation. Each structure has different tax implications, so choose the one that aligns with your business goals and minimizes your tax liability. Plan investments and timing. Coordinate your business investments, expenses, and income recognition to optimize your tax position. Timing purchases, sales, or expenses strategically can help you maximize deductions or take advantage of lower tax rates. Consult with a tax professional to assess the best timing for significant transactions or investments. Explore tax credits and incentives. Research and identify any tax credits or incentives available for your industry or business activities. Governments often provide tax incentives to encourage certain behaviors, such as investing in renewable energy, hiring local workers, or conducting research and development. Take advantage of these opportunities to reduce your tax liability. Consider outsourcing payroll and tax compliance. Payroll processing and tax compliance can be complex and time-consuming. Consider outsourcing these tasks to professional payroll providers or accounting firms specializing in tax compliance. This can help ensure accurate and timely payroll tax calculations, filings, and reporting, reducing the risk of errors or penalties. Regularly review and update your tax strategy. Tax laws and regulations change over time, so it's important to review and update your tax strategy periodically. Stay informed about tax law changes that may impact your business and work with tax professionals to adapt your tax planning accordingly. Maximize deductions. Keep track of all eligible business expenses and ensure you claim all applicable deductions. This includes expenses for office supplies, travel, professional development, marketing, and more. Expense reimbursement plans. Implement an accountable plan for reimbursing employee business expenses. Utilize tax credits. Research and identify tax credits specific to your business. Common credits include research and development credits, energy-efficient equipment credits, and hiring credits for specific target groups. Take advantage of Section 179. Section 179 of the U.S. Tax Code allows businesses to deduct the full cost of qualifying equipment and software purchases in the year of acquisition, rather than depreciating them over time. Consider cost segregation studies. If you own commercial real estate, a cost segregation study can help identify and reclassify certain components of the property to accelerate depreciation deductions. Evaluate entity structure. As your business grows, reassess your entity structure to ensure it aligns with your tax planning goals. Depending on your circumstances, converting to an S corporation or other tax-efficient entity structure may help reduce self-employment taxes or overall tax liabilities. Research tax incentives for your industry. Many industries have specific tax incentives or exemptions. For example, businesses in renewable energy, technology, or manufacturing may be eligible for industry-specific tax breaks. Research and leverage these incentives to reduce your tax burden. Utilize retirement plans. Establish a retirement plan for yourself and your employees, such as a 401k or SEP IRA. Contributions to these plans are typically tax-deductible, reducing taxable income while helping you and your employees save for the future. Take advantage of carryovers. If your business incurs a net operating loss, null, investigate whether you can carry the loss forward or back to offset taxable income in other years. Research international tax planning opportunities. If your business operates internationally, consult with international tax experts to explore opportunities for tax planning and optimization, such as utilizing tax treaties, structuring operations efficiently, or taking advantage of foreign tax credits. Implement a home office deduction. If you operate your business from a dedicated home office space, you may be eligible for a home office deduction. Leverage health savings accounts, HSAs. If you have a high deductible health plan, HDHP, consider establishing an HSA. HSAs can provide a tax-efficient way to save for medical expenses and potentially reduce your taxable income. Optimize your business vehicle deductions. If you use a vehicle for business purposes, explore different methods for deducting expenses. You can choose between the standard mileage rate method or the actual expense method. Use tax-deferred retirement accounts. Maximize your contributions to tax-deferred retirement accounts such as traditional IRAs or 401k plans. Contributions to these accounts are generally tax-deductible, and the earnings grow tax-deferred until retirement, reducing your current taxable income. Time income and expenses strategically. Consider timing income and expenses to your advantage. If your business operates on a cash basis, delaying the receipt of income or accelerating expenses near the end of the year can help reduce your taxable income for that year. Explore business tax incentives for hiring. Many jurisdictions offer tax incentives for businesses that hire specific groups of individuals, such as veterans, long-term unemployed individuals, or people from designated economically distressed areas. Stay organized and be proactive. Maintain good record-keeping practices throughout the year to ensure accurate and timely tax filings. Keep track of receipts, invoices, and other relevant documents. Consider the benefits of tax deferral. Explore tax deferral strategies, such as like-kind exchanges, Section 1031 exchanges, for real estate or installment sales for the sale of assets. Take advantage of business entertainment deductions. Familiarize yourself with the current regulations and ensure you are claiming eligible entertainment deductions. Remember, tax planning should always be done in compliance with relevant tax laws and regulations. Consult with a tax professional who can provide guidance based on your unique circumstances and jurisdiction to ensure you're maximizing tax savings while remaining compliant. Thanks for watching. Please like, share and subscribe.